Good afternoon, everyone. This is Kim Schmidt, Executive Editor for Farm Equipment Magazine. Welcome to our latest webinar in conjunction with the Western Equipment Dealers Association and the Midwest Southeastern Equipment Dealers Association. Today's presenter is Lance Formwalt, who leads Siegfried Bingham's Equipment Dealer Group and serves as General Counsel to the Midwest Southeastern Equipment Dealers Association and WEDA, along with several other of the regional equipment dealer associations. Before we dive into Lance's presentation, I have a couple of housekeeping items to go through. On your screen, there's a control panel with a Q&A icon. You can submit questions here at any time during the presentation, and time permitting, we'll look to answer as many of those questions as possible at the end of Lance's presentation. If for any reason your internet connection or even ours should happen to fail and it looks like the webinar has been interrupted, just go back to the email you received earlier telling you how to join, and you can re-enter the webinar that way. Okay, we're ready to get started. Thanks again for joining us, and take it away, Lance.
Great, thanks, Kim. Good afternoon, everyone. As Kim mentioned, my name is Lance Formwalt, and it's my pleasure to be with you this afternoon to talk to you about the exciting topic of sales tax. This is a topic that probably accountants, attorneys, and compliance professionals really love, but the rest of us just have to deal with. But the reason we're here today talking about it is that there's been some recent developments come out of the Supreme Court that significantly change things for dealers as you guys continue with transactions to sell to out-of-state customers. What we've seen is as dealers have consolidated, their customer bases have expanded, their customers have consolidated, that more and more it's not just about whether you're on the border as to whether you sell to out-of-state customers or not, whether it's through online presence or through an expanded scope of your business area. More and more dealers are selling out of state. And so we need to consider then what obligations you have as dealers in connection with those out-of-state sales. And so what I want to do is start by taking you through a little bit of the background as to what the current standards have been in the past, for the past several years, past couple of decades as to out-of-state sales, and then give you the update as to what's changing based on the recent Supreme Court case. And so with that, I just want to start with just kind of a real basic background as to, when we're dealing with out-of-state sales, what are we really worried about? And, as a very preliminary matter, what we're worried about is who pays the tax? Is it you as the business owner, as the retailer, or is it your customer who might pay a use tax if you're not paying the sales tax? And then you also have the question of what state is supposed to get their hands on the tax. And it's an easy answer if you're selling out of your store to the customer and they take possession of the store. That's an easy answer. It gets a little more complicated if things take place in a different manner. And then the last thing that you always are thinking about, whether it's a in-state or out-of-state sale, is the transaction exempt. And that's going to play a role in part of our discussion today, as I know most of the folks on the phone are primarily engaged in selling agricultural equipment. And I know throughout the U.S., generally, agricultural equipment is going to be exempt from sales tax. We're going to take that into account, too, when considering your obligations. So, what are we dealing with in terms of the current rules? And I've got up here the pre-Wayfair rules, because Wayfair is the most recent Supreme Court case that we'll be talking about in a little bit. But before Wayfair, there was a Supreme Court case called Quill, and that came out in the early 1990s. And that's kind of the Supreme Court case that's kind of set the law of the land, so to speak, for what we've been having to deal with for the past 25 years or so. And whenever we get into a situation in terms of trying to figure out whether another state can make us, as a dealer, have to pay tax, you get into a situation of figuring out, do I have nexus with that state? And that's just a fancy legal term that really gets to the point of, do I have enough connections with the state that they can say I'm doing business there and should be obligated to have to respect their rules about paying taxes? And so that was kind of the backdrop as to the Quill case. And the Quill case involved a mail order business that was, they were sending goods into North Dakota, and North Dakota was seeking to charge a tax, make that mail order business collect sales tax. And the Supreme Court took a look at that, and they decided, we don't think that's enough of a connection. We don't think that it's a significant amount of revenue involved. They're really just using the Postal Service. They're not really using the state at all. And frankly, it's going to be real hard. This is, again, pre-internet days. It's going to be real hard for that company to have to comply with their own state sales tax rules, North Dakota's, and maybe the other 48 states as well. And so, we're going to say they're not subject to North Dakota's jurisdiction. Instead, we're going to create this bright line test, and it's going to give guidance to everybody as to when they should be collecting tax when they sell out of state, and we're going to call that a physical presence test. And the problem with the physical presence test is for the last 25 years, we've been trying to figure out exactly what physical presence means. Every state's kind of adopted their own different guidelines. There's questions about how much physical presence is too much or to trigger sales tax. And we've been left with, frankly, kind of a mess for the last 25 years in this kind of situation. So it's really anything but a bright line. But I'm going to talk to you a little bit about what that means, because even with this new Wayfair case, the Quill case and its physical presence rules are still in place. So as dealers now, we're going to have to be thinking about that test plus the new test, and have to consider both of those when we think about out-of-state sales to our customers. And so when you talk about, again, as background, when you talk about when do you have a physical presence, it's kind of, there's a lot of different factors as dealers in your business models where it could come into play. The easy one is, do you have a location there? And no one, I don't think, really disputes that. If you have a location, you're going to register for sales tax and remit it for sales that come out of that location. But, if you've got some other parts of your business and maybe have physical locations, maybe it's a warehouse that's located across the state line, or you got a repair shop that's, dissociated from a sales facility, those would be enough to trigger a physical presence. But more commonly, you're probably thinking along the lines of, hey, you got sales guys. Everyone has salesmen that they go out and they travel and they see customers. And more, they probably don't really care whether the customer is across the state line or not. And so, but what you need to understand as a dealer is that meeting with customers or prospective customers in different states is one of the things that can trigger physical presence or an obligation to collect sales tax on transactions in that state. And the same thing with respect to your delivery vehicles. I know a lot of dealers have their own, they've got their own tractor trailers and they're delivering to customers. And if it crosses state lines, that can be enough to trigger an obligation to collect tax. And it's a different story, though, if you use a third party shipper. Normally, you do not have to worry about being subject to the other state just because you deliver through a third party into that state. But so that's another area where dealers can be exposed to potential issues. And then the other situation that commonly occurs, again, as dealers have kind of expanded their coverage through consolidation, there's been maybe some reduction in some cases of locations, but there's been an expansion of service through service trucks, and more work is being done in the field. And again, that oftentimes will take place, across state lines. You don't care where the customer, you're going to take care of the customer, and the state line is kind of irrelevant. But all of those things can make a difference and can create some obligations for you. And what you need to understand of the physical presence rule is that once you've got that presence there in that state, then all of your transactions in that state are going to be subject to sales tax in that state. Okay, and so that's the law. That's been the lay of the land for the last 25 years or so, and it's going to continue to be so. But the reality of that, as you kind of take a look at the complications that go with different states and how much presence is too much presence and things like that, is something we've tried to illustrate here with a cartoon we kind of took a little liberty with. But the basics of it is this: you're sitting around, you're talking about, what am I going to do about these out-of-state sales? We talk to dealers about the rules. People kind of eyes glaze over and say, it's just too complicated. We're going to ignore it. And by default, we're just going to kind of keep doing what we're doing and not really worry about it. And, like it or not, that's kind of what's happened for the last 25 years. And dealers are really no different than other business owners. And this is not something that is just only on dealers, but it applies to any other retailer that's been doing business out of state as well. And that's the reality of what we're dealing with under the pre-Wayfair landscape of sales tax rules. And so when you go back and you take a look at the economics of involved, because part of this is relevant to why we got to where we are with the new Wayfair case, is that one of the challenges with this physical presence test is that it was decided and determined before the internet came about, before emails and online retailing. And so when the Supreme Court was looking at this back in the early 1990s, and they were looking at the impact it might have on the states, they were predicting is only going to be about $3.25 billion of total lost sales tax revenue. Now, with e-tailing, e-commerce, and all that has been accelerating. Now we're looking in 2018, they were looking at $34 billion of projected lost sales tax revenue, and accelerating from there in 2022, they're projecting $52 billion of lost sales tax revenue. And so you're talking about a significant economic consequence that's coming about because of this physical presence test and how people are now conducting business with customers. And when we're talking about lost revenue, we're not talking about a zero-sum game here. It's not going from one state to the other. We're talking about a loss because the customer, if you're not paying tax on that transaction, sales tax, and your customer, in theory, is supposed to be paying use tax. And we've all been customers before, and I think most people kind of acknowledge either they say, "Huh, what's a use tax?" or they say, we're not really going to worry about that because it's just a small part of what we're doing as a customer. And frankly, we're not in the minority. There was a study done in 2012 that indicated that only 2% of customers actually bothered to file a use tax return and pay use tax. And so what's happened is, as the physical presence test has come about and it's become very complicated, and you got more and more online retailing, those sales tax dollars are just going out the window. They're not going from one state to the other. They're just not being paid. And so that is a very significant change from 1992 until present day. And the other thing that was going on is that the e-tailers, and kind of led by Amazon, they're actually they're changing their business model to take advantage of this and anticipating that customers weren't going to pay use tax. They would go out of their way to avoid having a physical presence. They had a lot of attorneys giving advice, paying attention to this, and they would go, "Hey, we're going to avoid business travel to a particular place. We're not even going to go interview at business schools because we don't want anyone to be able to say that we have a physical presence in that particular state, so that we can count on having a margin advantage over brick and mortar retailers that had to pay sales tax in those states." And so that there's a whole secondary economy and business model is being built up around that. Again, not only costing states a loss of tax revenue, but frankly creating a little bit of an unfair playing field between the online retailers and the brick and mortar folks. And not unlike what you may be seeing in your own business, there are some dealers that take advantage of some of these sales tax rules and the fact that customers aren't going to pay use tax with dealers that are in the state and they have to collect sales tax. And so we see that many times. I get calls from dealers on both sides of that fence. And so we all understand kind of that margin impact and how that can impact your business. And so what has happened from a dealer standpoint is, as I mentioned already, even if you were aware of this physical presence test and the potential you had to collect sales tax on out-of-state sales, you really had a hard time understanding the obligation. It's no fault of your own. It's hard. It's hard to figure it out, and it's hard not only for you to figure out, but it's hard for the auditors to figure out. With the physical presence requirements, a lot of it is a matter of degree. How much am I doing this activity or that? How often are my salesmen in this particular state? And because there's always an argument, there's usually always a defense. And so it's just the idea of this being a bright line test is not only it's not proved that way in practice, and it's also not proved that way from an audit standpoint as well. And so ultimately we've left it to the customers to report use tax, and as I mentioned earlier, they're not doing it. Okay, and so the reality is this physical presence test hasn't been very effective from a government standpoint at collecting sales tax revenue or giving clarity to retailers. And so because of that lost sales tax revenue and other things, there are a lot of different economic changes that were taking place. Is actually encouraging some of the Supreme Court members, even going back a few years, Justice Kennedy is one of the swing votes at the time, had been encouraging the Supreme Court to kind of revisit this issue just to take into account the different economics that we're operating under in our various business models. And it's because of the lost sales tax revenue, the physical presence test, like folks like Amazon, it was actually discouraging business expansion and encouraging non-compliance. You have businesses kind of counting on customer non-compliance as a way to help improve their business in competition with brick and mortar businesses, which created an unfair playing field. I mentioned earlier that one of the things that led to this physical presence test was concern about businesses being able to comply with sales tax schemes in multiple states. Well, as you all know now, with the advent of computers and the internet, and most of you, if not all of you, on this webinar are operating under fairly sophisticated business systems that likely have the capability of calculating and determining sales tax obligations arising under different states or all of the states. And so the justification that it was going to create a big burden on businesses is no longer there. And then finally, from a state perspective, it's also hard now for people to say that people out of state, especially e-tailers, aren't taking advantage of the resources the states are selling into as states have spent a lot of money on upgrading broadband networks. We've seen that in rural areas as well. And that investment is now allowing people out of state to more efficiently engage in business with the folks that live in that particular state. And so all those different economic reasons, have represented shifts from the early 1990s to today, and have created, recognition that, hey, we've probably got to take a look at things again a little bit differently in terms of how we figure out when a state has the ability to make a retailer or a dealer collect sales tax. And so from that time forward until now, we get to the Wayfair case. And the Wayfair case, what it came about was what it really was doing was taking a look at a new South Dakota law that went into effect, and they were trying to assess, is there a situation where the South Dakota law is constitutional? And South Dakota had actually proposed a new economic nexus test, and the idea was we're not going to look at whether you are physically present in our state. We're going to look at how much business are you doing with people, with customers, the citizens of our state. And in South Dakota, what they picked as a standard was they said, look, we think if you sell more than $100,000 of stuff into our state, or if you do that 200 or more times, if you got a lot of transactions with customers in our state, that should be enough to say that you got enough connections with our state that we, South Dakota, should be able to require you, the dealer, to collect and pay over sales tax to us on those transactions. And the court, in looking at all those economic reasons, justifications, they said, you know what, we're going to allow that, we're going to uphold that and say that's enough nexus to justify that, and we're also going to keep in place the physical presence test. And so again, now we've got two standards that we're operating under. And so that case was decided in 2018, and now we're trying to figure out what does that mean for the rest of us that aren't in South Dakota, okay? And so the impact of this for dealers around the country is that almost any state, there are a few states that don't have a sales tax, but almost all states that do have a sales tax have quickly glommed on to what South Dakota did and adopted something pretty similar, a pretty similar economic nexus standard. There's only 5 states today, and it's kind of changes really almost on a daily basis as to who's doing what. But as of today, there's only 5 states that really do not have economic nexus laws that are enforced. That's Arizona, Florida, Kansas, Missouri, and Tennessee. But what I can tell you is there's activity in all of those states, and that our expectation is that within the next year or so, I think this, right now the reason is probably just political, that things haven't been adopted. And the next year or so, that it's likely they will be adopted as these states see that, hey, look, that's part of the revenue pie that we should be getting access to, and they'll probably join the other states soon enough. Most of these states, because the Supreme Court has weighed in South Dakota's law, most of these states are saying, hey, we're going to adopt something similar so we can better be comfortable that it won't be overturned as being unconstitutional. And so most of them have adopted some sort of a dollar threshold, and then also a number of transactions. Now, a lot more states are starting to rethink that transaction test, and we'll probably see some folks maybe drop that as it's just harder from an audit standpoint to get through, and probably smaller potatoes when you're thinking about, is it really worth going after a lot of $5, $10 transactions just because there's a number of them by one retailer, and they'd rather focus on the dollar amount. We've seen generally states are following the $100,000 threshold, again, because of what the Supreme Court has already ruled on. A few states like California and Texas have adopted higher thresholds. I think about $500,000 to trigger for their state to have for you to have economic nexus in those states. Oklahoma originally had a $10,000 threshold. We think there was probably some concerns with constitutionality there, and they've since gone back and revisited that, and they've bumped that up to $100,000 as of this fall. And so, the states are all taking a look at this. And so this is something that if you are in a state that has a sales tax, or if you are selling into a state that has a sales tax, you're going to have to start thinking more as a dealer about what do I need to do in response to this. And the timing for this it's on us right now. The states are ready. The states are anticipating the Wayfair ruling, and a lot of these laws started kicking in towards the end of 2018, and then are coming into force throughout 2019. And so for many folks, the obligation to start reporting under these new rules is in place right now, or is going to be in place extremely soon. And so it's a very timely subject to be thinking about as an equipment dealer. Now, so when you think about kind of how likely is it am I going to be subject, we know the legal answer is that you could be subject, but how likely is it that I will be subject as an equipment dealer to these new rules? And what I'll tell you is, it won't be hard to figure this out, is I think it's going to be fairly easy. When you go back and you take a look at where you're doing business, as you know, selling one piece of equipment can easily exceed that $100,000 threshold. And once you exceed that threshold, then you're going to be subject to these new rules. And most of the states out there have adopted kind of an either-or rule. They'll look at what you do in the year or 12 months, generally the year prior, and did you exceed the threshold? And if you did, then you need to start complying. Or if you exceeded it in this year, you need to start complying. And under either of those scenarios, once you hit that threshold, then as a dealer, you're going to have an obligation to register with that particular state and start collecting and remitting sales tax on your transactions in that state. So it's something now that as a dealer, you got to start measuring where you're doing business and how much business you're doing in those particular states with your customers. As you think about that, though, and you kind of lead to, inevitably lead to some other questions about where do you take this as a dealer, and some of the nuances as a dealer. You start thinking about compliance. I'd mentioned earlier the fact that many of your transactions are exempt because of agricultural equipment exemptions that are in place in a lot of the states where dealers do business. What you need to understand, though, is that the fact that those transactions may be exempt from tax does not change the fact that those sales will count for purposes of whether you meet the $100,000 threshold or whatever it might be in the particular state that you're considering. And the reason for that is that, again, if you go back to it, the Supreme Court has said, hey, we're going to look at the amount of business you're doing in the state. We don't really care about whether it's exempt or not. We just think that's the appropriate amount of business to trigger a sufficient connection. Okay, so you just got to remember that exemption piece, they don't care about that for establishing nexus. And so what the consequence of that for you as a dealer is that most of you have some ancillary equipment that you sell beyond farm equipment. And so you might be selling snowmobiles, ATVs, UTVs, lawn and garden equipment, maybe some construction equipment. All of those things are more likely to be subject to sales tax than your ag equipment. And so it could be that you'll owe sales tax to a state on some kinds of equipment and not on your ag equipment, which is really the same situation you likely deal with in your home state today. And you're good at it in your home state. The issue and the challenge you have now is that you may be picking up 4 or 5 other states where you got to be thinking of these things. The other thing to realize is that some states have different tax rates based on local or county differences, and so those are also going to be picked up. If you're subject to an out-of-state sales tax, you're also going to be subject to understanding and reporting and remitting any local and county-based sales taxes as well. And the thing that, I think one of the things really important to understand with respect to the new rules that are coming into play here is that these are more objective. These are, while you kind of go back to that cartoon where it's just complicated, we can kind of get away with ignoring it, that default route, because no one else really understands it either. That's not going to be the case anymore. The idea of measuring how much business you do with people in other states it's just going to be, on the one hand, easier to figure out, but if it's easier for you to figure out, it's going to be easier for the state to figure out. And so your defenses in a kind of an audit situation are going to be harder to come by. The other thing you need to remember is kind of a corollary to that too, is that I talked earlier about how you ship equipment. And if you had shipped equipment, if you sent equipment into a state through a third party shipper, the issue there, they just look at whether the person, did they take possession in that particular state. Okay, so that the issue on the shipping is a little bit different story now under the new rules than under the old rules. And so again, there's a lot of different things that are going to come and make it simpler for you to figure out whether you owe tax, but it's harder. It's going to be harder to avoid in an audit situation, harder to hide from it, so to speak. Another thing that for dealers that, we spent a lot of time working with dealers on transactions. We've done, now over 100 transactions with equipment dealers in the past 6 years, whether it's a purchase or a sale or a merger. And as part of those transactions, you have to go through some due diligence, which nobody really likes to do. But this is another area now where dealers have to start focusing with as much consolidation as there is in the industry. If you're looking at merging with somebody or if you're looking at acquiring somebody, you have to understand that a potential risk in that relates to your merger partner or your seller's sales tax exposure. And have they been collecting sales tax in the states where they should be collecting sales tax? And because if they haven't been, then you have exposure as a merger partner. You definitely have exposure if you take on all the liabilities for any of those past issues. And as a buyer in most states, the law is set up to where the buyer, even in an asset sale, has successor liability for sales tax issues. And so again, this isn't so much a concern for pre-Wayfair issues, really hasn't been that much of a concern, but going forward, once these new standards come into play, this is going to become kind of a new and emerging issue that dealers involved in acquisitions also need to be considering. So now it's not just about your compliance, but it's also thinking about the transaction, the person you're transacting business with, is going to be about their compliance. And so those are some other things that as a dealer, you need to start thinking about under this new set of rules. So what should you be expecting going forward? One thing I think you're going to see is you probably, as dealers, we're going to see some increased audit risk. And I'll say in the next few years, because like anything else, I think that you'll see that the states will probably give some time period for dealers and other retailers to get up to speed. There's a statute of limitations, which often is, I believe, 3 years in a lot of states. And so audits a lot of times tend to pop up as you kind of get towards the end of that 3-year period for the prior years, so they can kind of make sure they're not losing the ability to audit those years. And so I would expect to see here a couple of years down the road, we're probably going to see more audits come into play that deal with the new Wayfair standard. And as I mentioned, I think those are going to be harder to defend against because it's going to be more cut and dried as to whether you're doing business in a particular state. I also think that you're going to start seeing more information coming out from other states. Folks are, some states are sending notices to dealers right now, really more, they're out-of-state dealers, but more of advising them about, hey, these are the new rules that are in place. You need to think about whether you have to register and start collecting sales tax on business you transact in our state. Departments of Revenue are putting out resources online. But also, I would anticipate that as a dealer, you're probably likely to start receiving some questionnaires from the states asking about how much business you do with a particular state. And this is a common tactic that's been going on. I represent some franchisors as well, so they collect royalties from franchisees. So states from time to time will send franchisors questionnaires about, hey, are you doing enough business in our state that you should be paying income tax in our state? The same concept, the same Department of Revenues they're going to be applying that same concept with respect to these new standards. And so when you get these questionnaires, you're going to have to be making some decisions about how do you respond to that. But that also could then trigger an inquiry as to your practices and whether you owe sales tax in those states. And so at the end of the day, the bottom line is, I think as dealers, by and large, because of the way you conduct business today, you're probably going to be looking at increased sales tax reporting obligations. Okay, it's just kind of, plain and simple, I think most folks are going to be looking at some kind of an increase under this new standard. And so when you look forward as to what you should be thinking about in terms of next steps as a dealer, because of the fact that these new standards are going in place as we speak, I think it's important for dealers to immediately assess your exposure to taxes in other states. And so this is going to be mean looking at your sales of different kinds of whole goods. You're going to look at your rental transactions, parts sales, and possibly even service and sales, because in some states also tax repair work transactions. You need to, as a dealer, now assess the availability of sales tax exemptions in those states. Again, I know you're really good at understanding what the exemptions are in your state, and some of those complexities are involved in that. Now you need to also figure out, are they available in the other states? So because while it doesn't matter for purposes of collection of tax in that state, whether the sale was exempt or not, it does matter in that particular transaction. Okay, and so if in that transaction, in that particular state, it's exempt, you don't have to collect tax, and you may have to collect tax in other non-exempt transactions in the state, but not in that state, not on that particular transaction. And so you need to now start assessing what's out there for you to benefit you and your customers in those particular states. And on top of that, you've got to figure out, what do I have to keep? What do I have to get for my customer from a documentation? What do I have to retain for documentation to be able to support those exemptions in those different states if you do ever end up under an audit? Remember, the audit now may not just be about whether you have to collect in that state, but then did you collect enough based on the transactions that you were undertaking? Once you get a handle on those things, you're probably looking at a change a little bit in your business processes. And so you got to think about, do I need to implement some policy changes, some process changes? And with that's going to come training your personnel and making sure your business systems are up to snuff. Are they capable of handling this? And they've been coded the right way? Do they reflect the right information you need to be able to comply with your legal obligations in terms of reporting tax? And then finally, as a dealer, because we're in this transition period, there is the potential that folks are going to be doing things incorrectly, or they've missed doing something in a particular state that they should have been doing in. And so one of the things you want to be considering with your advisors is taking a look at, if I do find out maybe I haven't been reporting everything I should I look at some voluntary disclosure options with that state? And the reason you'd want to look at that potentially is, in a lot of situations when you do voluntary disclosure, that state's going to be a lot more amenable, or may even have a form of program to where you'll be able to avoid penalties and interest, or both, with respect to those taxes that hadn't been paid. And so that's a situation that, as soon as you kind of understand that, you'll want to assess that risk in that particular state as well. And so as a dealer, there's a number of things that you should be looking at today in terms of reassessing where you may have issues in your business. And so in terms of kind of going forward from a dealer support standpoint, I want to let you know, we've been helping dealers out already with, we've got a streamlined process to help dealers quickly assess kind of where they might have obligations and when will they come into effect. And then once you kind of understand that, then you can start kind of taking a look at your individual processes. Because of the work we do in a lot of transactions, we have been and will be conducting assessments from a sales tax exposure situation, from a due diligence standpoint in sale and merger transactions. There will be, we're going to be available to work with your associations to develop information on sales tax exemptions and documentation. Again, I think if you're in a state, you've already got a pretty good handle on that, but now there's going to be probably significant interest from dealers that aren't in your state about what your sales tax exemptions and obligations are, and vice versa. And so that's going to be a great role that the associations can play in terms of putting together information that can be for the benefit of the members in each of those states. And then one thing I want to make sure that you understand is that as we kind of go forward in these new rules, if you do get some kind of an interview or questionnaire or something like that from another state, my advice to you is always going to be, do not ignore that. Okay, you don't want to just walk away from it, but you do want to contact us or your local attorney to make sure they see what you're being asked to respond to, because sometimes those questions they may be a little bit misleading, may not be complete, they may not be accurate in terms of what the law or the exemptions actually read. And so the answer is usually not to ignore them, but the answer may be to maybe respond to those questions in a way that's kind of reframing it based on how you and your attorney view the law, how you view your business, and that could be in the context of a letter, maybe supplemental information to go along with the response to the questionnaire, what have you. And so it's something you want to be thoughtful about before just turning around, writing down numbers, and putting it back in the mail. And so there's a number of things that we can provide answers and support for you as you consider some of these things in terms of next steps. And unfortunately, like it or not, we're in a situation where this is a significant business change or business circumstances changing that has some real dollars associated with it. And so you need to be ready as dealers. And so, with that, I want to go ahead, Kim, we can go ahead and open it up for a little bit of Q&A. And if you got some questions, I'd be happy to try to answer those now.
Yeah, that sounds great. Thank you. So we've gotten a lot of questions in, but it looks like we've got a fair amount of time, so we should hopefully be able to get to most of them. So we had one question about if someone comes to Texas to buy ag equipment and they have an exemption certificate from another state, should the dealer in Texas charge sales tax?
Well, so that's a good question. I think in that particular situation, if they're coming to Texas, then really what you have to make sure is that you've got an exemption available in Texas for that particular piece of equipment, and that what you're collecting, the information you're collecting, the certificate you're collecting, is going to be sufficient to support that under the Texas exemption.
Okay, and then this is fairly similar, but I'm not sure if the answer will be the same. So a dealer in Louisiana is in Louisiana, but on the border with Texas, and there's customers who are going to Texas and buying tractors but not paying the tax. Who should be collecting that sales tax?
So it's customers that are in Louisiana going to Texas?
Yes, I think so.
In that situation, if the customer is actually buying from a dealer in Texas, then the situation is the Texas deal. That's going to be a Texas transaction that you'll be. So the Texas dealer should be looking at making sure they comply with the Texas sales tax rules.
All right. And then if a single repair is done in another state, or is a single repair done in another state enough to trigger a physical presence clause? If not, where's that line?
That's one of the very significant challenges in terms of the repair, and is it enough? I would tell you just off the cuff, I'd be happy to defend that as saying it's not enough to trigger it, but it's going to depend on each state, and so it's something that I think the likelihood, I know a lot of dealers have been doing that, and I can tell you we get calls from dealers all the time, and I have not had a dealer yet been audited with respect to that particular scenario. So I think the risk there is fairly low. But once you get beyond one, you start making it a habit and doing more and more, you're going to increase your risk.
Okay. And then when you were talking about the $100,000 threshold, is that taxable sales or total sales?
That is going to be total. That's going to be total sales. Okay, so the $100,000 again, they're trying to measure how much business a dealer is doing in the state, and for that purpose, they don't really care. From a constitutional purpose, they don't care whether that revenue is actually subject to sales tax or not. And so that's what makes it kind of dangerous for dealers, and more likely they're going to have to comply because a single transaction is likely going to put them over the top. And then there are other transactions after that are going to be subject to tax.
All right. So this one is kind of interesting. On tractors, why do people have to pay a full sales tax? Some of these tractors are obviously costing far more than a car does, and you don't pay full sales on a car or truck. It's 7% where this person's located.
Well, I'm not I'm sure I don't understand the question completely, but I think ultimately, I think the idea behind the sales tax is just it's based on the value of that particular item that you're buying, and so there's generally not a in most places there's not a cutoff in terms of value. So even you could have a car that's obviously cars are a wide range of prices too, and you pay the sales tax. A lot of times you only pay the sales tax on the full amount of that value of the car. If you're talking about trade-ins, if trade-ins are involved, I do know, a lot of states will give credit, but that usually applies to both. It applies to both automobiles and other kinds of equipment or things that get traded in as well, where you could get that doesn't count for purposes of sales tax calculation. But unfortunately, that's just kind of the way the rules are set up. So it's just, ultimately, if it's more expensive, there's just going to be more tax associated with it.
Okay. And then can you explain how economic nexus applies to income tax nexus versus sales tax nexus?
Well, that's a good question. So income tax nexus is really a little bit of it's a different standard and completely. Okay. And so sales, they've got their own set of rules. They're defined by statute. They're going to be in each particular state. And so this economic nexus test is really only for sales tax. Okay, the Supreme Court case had nothing has changed from an income tax nexus perspective because of that Supreme Court case.
Okay. And then if a dealer qualifies to collect tax one year, do they automatically need to collect the following years, even if they don't hit that $100,000 threshold?
Yeah, that's a good question. That will vary by state in terms of trying to figure out when you need to comply. A lot of states do look at the past year, and so if you've hit the threshold the past year, then you're going to be obligated to comply for the next year. And some apply both. Some say it's what you did last year or it's what you do this year. And so once you hit the standard, now you don't. If the standard is, hey, if you have to have $100,000 of sales in this year before you're subject, you don't have to worry about the first 100,000. Okay, you only start after you hit that 100,000. But the answer, unfortunately, is really it's going to depend on each state. So it's something that you have to look at under the particular state law.
Okay, and then our next question is, what's the appropriate method for dealing with a transaction between a destination-based state and a origin-based state?
So that's so the destination-based versus an origin-based state. I mean, ultimately, the economic nexus rules are now going to be based on where is the equipment at when the transaction occurred. Okay, so ultimately, if the transaction, if you are sending equipment to a customer in another state, you're going to be subject to potentially sales tax in that other state. And so it really kind of takes that the destination and origin, I think, has been more about title and when title actually transferred. And now we're looking about where is the customer at that is actually getting the benefit of the equipment. And so it's a little bit of a distinction. And I think by and large, the economic nexus test is going to be more clear cut in terms of the fact that if you send equipment across state lines to a customer, that's the state that's going to be entitled to it. And so I think this is going to be a little more cut and dry than when we're dealing with the physical presence rules as to who is trying to collect it. So I do anticipate there being some conflict, but I'm gonna kind of more side on the standpoint of trying to comply with the economics nexus rules because I think they're just going to be easier for people to enforce, and that's what people are going to be focusing on going forward.
Okay, and then where can a dealer find sales tax rates for various delivery destinations in other states? Is there a resource for that?
Oh, there are different resources that have sales tax rates. I will actually, I'll look to see if we can get some information on something that we can provide out there. But you obviously take a look at the rates. Then you have to understand the exemptions as well. But yes, there are going to be resources out there which will report the different sales tax rates.
Okay, and then Sorry, there's a lot of questions. I'm trying to keep track of them all. What about the tax adjustment for traded in equipment?
Yeah, by and large, there is a credit from a from a sales tax perspective when you got trade-in equipment. You look at only taxing the net value, so you don't take into account the trade-in. The trade-in value is excluded for sales tax purposes. Now that does vary by state, and so you have to look at it. But that's the general that is the general rule. And so again, most dealers in their home state are going to be kind of aware of that, and now they're going to have to get up to speed as to if they're if they're doing business with other states, that's going to have to become a factor as well. But the general rule is it will be that trade-in value is carved out or excluded for purposes of calculating sales tax.
Okay, and then will U.S. states audit Canadian dealers? And then is there any other issues that might come up for Canadian dealers with this issue?
Yeah, so from a Canadian, it's a great question. For Canadian dealers, I mean, ultimately, the idea of having jurisdiction over someone that's not in your state, really, it doesn't make a difference if they're in another state or if they're in another country. So Canadian dealers are going to be subject to some exposure under these rules. Now, from a practical standpoint, when you look at audits and trying to pursue people to get them to pay taxes and comply, I think there's probably still a little bit less risk for Canadian dealers just because it's in a different country. Okay, there's less likely to be as much cooperation, cross-jurisdictional support, and things like that you might see between states. But the actual jurisdictional rules and when you are doing business in another state doesn't matter. It doesn't matter that you're in another country.
Okay, and then if a dealer sells a taxable piece of equipment in their store but deliver it to another state with a delivery fee, is it just the delivery fee due to the other state, or is the whole transaction?
Well, if the delivery is made to the other state, then the transaction is likely going to be the entire transaction be subject to tax or eligible for consideration as an out-of-state sales. Okay, so that's going to then depend on whether it's exempt in that other state, whether you've triggered the threshold in that state. But the idea is that if you're delivering it to another state, that's now where the transaction is going to occur from a sales tax perspective of the economic nexus test.
Okay, so this I think is a clarifying question from something you might have said earlier in response to a question, so bear with me. So if a customer drives to another state and to an out-of-state dealer to make the purchase, is the customer responsible for paying the sales tax in that state?
Yeah, so by and large, if your customer's coming to you, so that transaction takes place there, okay, then it's going to be a transaction at your dealership, okay, and so there's still going to be nuances that when we talk about shipping in and out and title transfer and all that, but generally, if the customer's coming to you, they're getting the equipment there. That's where the transaction is taking place.
Okay, so this dealer says they have several suppliers insisting they need to charge U.S. sales tax on orders that are being drop shipped to their customers in states where they're not registered. They're charging the customer for the order and sales tax if they're not exempt. So the additional tax is affecting their margins. How can they address that with their suppliers?
Well, I mean, their suppliers by and large actually are with drop shipping. There are a number of states that have adopted rules that say that if you drop ship through a third party into your state, so if it's coming from a manufacturer, for example, that it is subject to sales tax in that particular state. And so my guess is, and again, this kind of ties back to the physical presence nexus test, but by and large, those are coming out of regulations those particular states have adopted. And so there's, the manufacturer is simply, in those cases, likely just trying to follow the state law.
Okay. And then this is the dealer's in Iowa and has an eBay site in which they sell John Deere products all over the U.S. They currently charge sales tax to Iowa, Illinois, and Wisconsin, but otherwise no sales tax is charged. Are those rules going to change in regard to sales tax and online sales?
They are. In fact, that's probably the online sales transactions, frankly, probably the biggest driver as to why these rules have changed. And I think kind of one of the signals is, I think folks, a lot of the big online retailers actually have started charging, they'd started voluntarily before the Wayfair case was decided, charging sales tax in other states in anticipation of this. And so it's going to be the same scenario for dealers that have an online presence in terms of where they're selling.
Okay. And then what if a customer calls in and does the deal over the phone, and then a third-party company is who delivers the machine? Would you still charge the sales tax in that situation?
So, yeah, in that particular situation, there's a lot going on there. Okay, so my view is on the customer calling in and then the delivery into the other state. That I think the other state, it's going to be a transaction that's going to be covered by the other state.
Okay. And then how long before the states adopt an economic nexus for income tax in your opinion?
I think the income tax and sales tax have been viewed as completely separate issues. So I actually don't, I don't foresee a big change coming in that area. I think the focus has been on the sales tax and probably stay there for purposes of this test. My expectation.
All right. So this dealer's right on the border of Minnesota and Wisconsin, and they're selling a lot back and forth. They have a customer who's tax exempt in Minnesota, and are they automatically exempt in Wisconsin or vice versa?
No, the exemptions are going to be state law driven. Okay, and so it will. Now, in a lot of situations, you may find if there's an ag exemption, the ag exemption may not be specific to someone that's just in that state. Okay, and so it might apply to someone that's out of state. But each state, though, you got to first figure out where's the tax owed, and then you got to look at that particular state law and decide, is there an exemption for that particular transaction? And sometimes it's based on the equipment, sometimes it's based on what business the customer's in. It'll just depend. So you can't just make the assumption that they're going to be the same.
Okay, and then do they need to get an exemption letter from an ag customer from a state they're not registered in?
So if the customer, again, it probably depends on where the transaction occurs. Okay, if it's an out-of-state customer coming into a state, you got to worry about what do I have to document in my state for the exemption. Okay, if you are going to another state, you have to decide do I have to register or not based on the number of sales that I have in that state. And so my advice to you, though, would be that if I'm selling to a customer in another state, and I think that that customer's got, and it's not going to be subject to tax in my state, but it's going to be subject to the other state if at all. I'm going to try to understand the sales tax exemption requirements in that state and try to document that, because then even if I later get audited, whether I'm registered or not, I'm going to at least have the ability for that to be an exempt transaction. And so you want to at least understand that, if you can, try to have that documented.
Okay, and then once applied with the state, do you wait to be notified if any county or local taxes are owed as well?
When you get into the states, ideally that's one where my advice would be to try to find out the scheme in that particular state, if they do have different county taxes. And frankly, I try to rely on my business system provider to try to get that incorporated and figured out, so you're not having to manually do that. But obviously there's less at stake than at the overall state level, but it's something that once I know I'm going to be involved in that state, I'm probably going to try to figure out on the front end and get it programmed in.
Okay, and then this probably will be our last question. So if you're selling parts through Amazon or off your website, are those parts subject to tax? Do the transactions count toward physical presence for the state? There's some confusion regarding mail transactions.
So if you are, I'm sorry, can you go ahead and repeat that? Can you repeat that question? Make sure I picked up on the right way.
Sure. So if they're selling parts through Amazon or off their own website, are those parts subject to tax? And then the second part of the question was, do these transactions count towards physical presence for that state? Gotcha.
Okay. So from a parts standpoint, so sales are going to be, any sales into another state are going to be subject to the economic nexus rules. Okay. So you're trying to anticipate that. And that's a separate question from whether they're exempt or not. From a physical presence standpoint, if you're shipping them through a third party, then likely they're not going to trigger physical presence. But they will count from the new economic nexus standpoint. So the new test, you're going to have to consider those parts. Now, if you're selling through Amazon, I don't know the exact logistics of this, but there may be some collection of sales tax that's already occurring through the third-party website. And so if you're in that kind of scenario, then you don't, they're taking on the obligation to report and remit sales tax. That's really kind of a separate transaction from you guys being the individual seller.
Okay, that sounds good. And there's been a few questions that have come in about getting a replay of the webinar and things like that. And we will be sending out an email to everyone who registered when the replay is available. And Lance, we got a few questions about if people would be able to get a copy of your slides. So if that's okay, just let me know. You can tell me offline if you want.
I don't have a problem with that.
Okay.
That'd be fine with me.
So if anyone is interested in getting those slides, when you get the email about the replay, just reply back to me and I can make sure you get a copy of those. Okay, well, that is all the time we have today. Thank you everyone for joining us. As I just said, the presentation in audio will be available on the Farm Equipment website in case you want to go back and review it or share it with anyone else at the dealership. Keep an eye on your email and the Farm Equipment eWatch newsletter for more information on that. On behalf of Lance, Weta, the Midwest Southeastern Equipment Dealers Association, and our entire staff here at Farm Equipment, thanks for joining us for today's webinar. When you leave the webinar, a survey is going to pop up. Please let us know what you thought of the event and if there's any topics you'd like us to cover in the future. Thanks again and enjoy the rest of your day.